This week, I'm going to go over how you can become a millionaire by only investing $20 a month. I remember when I was a little girl and I used to dream of having all these nice things and new clothes. And you see, my parents were very young when they had me. And we grew up in a very small town, so there wasn't a lot of opportunities for us to have extra money to buy nice things. So don't get me wrong, we never went hungry, but because we lived in a small town and jobs were hard to find, my parents had to do what they had to in order to make ends meet. So since I seen my parents struggle so much, it gave me the drive that I have today. So when I was 13 years old, I started delivering newspapers. I wanted to start making money so I could buy candy and toys and things like that. Delivering newspapers was a really easy job to do. I was able to do it after school every day. It took me about an hour every day. So that gave me an opportunity to earn my first paycheck. So since this paper route only gave me really some chunk change, a few years later, I really had the drive to make more money. So I would dream about all the things that I wanted to buy. I wanted to buy a new bicycle, even small things like a new electric toothbrush. When I turned 16, that's when I got my first real job. I worked at a sub restaurant, so at a restaurant where we would make subs. So it was a very, very hard job. We had to cut all the ingredients and clean the entire store. So it gave me a lot of opportunity to learn a lot of skills, and I'm very grateful for that first job. You see, I also feel that being successful requires you to not only dream about what you want to achieve, but also write down what your goals are and what you want to achieve. Now, if you write down your goals and you feel the emotions of what it would be like to achieve these goals, you'll have a better chance of achieving those goals more quickly. Now, the first summer that I worked at that restaurant, I told my dad, I want to buy a new bike because I would ride my bike all over the neighborhood. Back then, that was the thing. So we went to the bike store and I found this beautiful bike that I wanted to buy. At the time, it was $450, and that was a lot of money like 2 decades ago. So my father said, okay, I will lend you the money. I'll put it on my credit card. You can pay me back. So that entire summer, I worked really hard and I paid him back for that bicycle. So at the time, I lived with my grandparents, and my grandfather was a big day trader. So at the time, he told me every dollar you put aside in a savings account, I will match that 100%. And at the time, I was too interested in buying a bike, I guess. But I realize now today that if I would have taken his offer, I could possibly be a millionaire today. You see, my grandfather knew the importance of investing your money as soon as possible, because the longer you have it in there, the more quickly you will make money over the long term. And if you start early, you don't have to invest as much. His investments today, although he has now passed, have helped my family greatly. It has allowed my grandmother to live a good quality of life later in life. You see, my grandfather knew the importance of compound interest. If my family would have started investing $20 a month in a savings account, or an equity account, I should say, back when I was born, today I would actually be a millionaire. You see, now I look back, I wish I would have invested much earlier, but at the time I didn't realize how important that was. But the key is to start as soon as you can. The past is already in the past, so all you can do is start now. That's what you need to do, that's the key. So I wanna show you guys something. So this calculator is on Fidelity Investments website. It's their investment growth calculator. So this calculation shows a $0 initial investment, 42 years to grow, because that's how old I am. The rate of return is 16.4%. So that's what, in my other video, we were showing how an average annual return of around 16% in the ETFs that I was talking about earlier. And the contribution is $20 monthly. So in 42 years, your projected savings will be $1.16 million. So So the amount invested is $10,000 with the compound effect within so many years. That's what will make you the millionaire. Now you're probably asking me, Suzanne, so when should I start investing? Well, that's why you need to start yesterday. Start right away. As you can see, investing as little as $20 a month over 42 years is going to make you a millionaire. So can you imagine if you have children, as soon as they are born, open them a savings account or an equity account, and with those funds that you invest $20 a month in that account with, you will achieve a couple $1 million. By the time they retire at 65, there'll be more than $2 million in that account if you can achieve that 16% annual return. I also want to remind you that return is based on an equity ETF. Now, equity funds normally are more volatile. So just like the market, there's going to be some years where you may be down significantly, but you will also be up significantly in other years as well. Just keep putting that money in there. Don't touch it. Don't look at it. Let it grow. So again, I'm not a financial advisor, but do your own research and find the best account that suits you and your family. Now, the second thing you want to do is also make sure you have a savings account with 3 to 6 months of living expenses. Because the last thing you want to do is, if the market crashes, which it will eventually, because it always does, is you want to make sure that you don't have to take money out of that account. So always make sure you have 3 to 6 months living expenses in a separate account. Third thing you want to do is to determine what type of account you want to open. So there's 3 major accounts out there. The first one is a cash account. So the cash account is basically just what it is. It's not going to give you any taxable benefit, but it'll be easily accessible and you won't need to pay any taxes if you take money out of it. Now, the second one is in Canada is a retirement account, an RRSP account. Now, those accounts will benefit you in the way that they will reduce your taxable income. Every dollar you put in there will reduce your taxable income that year. So that will give you more of a tax benefit. The goal is when you retire, you're likely in a lower taxable income. It's basically an account that allows you to defer your taxes. You want to defer those taxes in your higher income earning years so that when you do take it out, you'll end up paying less taxes during those years because you'll be in a lower taxable income. Now, the third type of account is your TFSA. So in Canada, it's called tax-free savings account. So the benefit with that, it does not lower your taxable income, but the money that you earn in that account will be non-taxable. So that's the third type of account. The last two, the retirement and the tax-free savings account, both have annual limits to contribute to. So what you want to do is you want to look at your notice of assessment when you get your income tax return completed. You'll get that form from the government and it'll show you what your limits are. It'll show you what you have left for your retirement benefits as well as your TFSA benefits. It'll show what your balances are because they do carry forward every year as well. So there you go. So once you decide what type of account you are looking at opening, then you want to look at the different types of ETFs or index funds that are out there. Now, a lot of people will suggest that you may want to invest in the S&P 500. So that's a great recommendation. A lot of ETFs nowadays invest in the S&P 500 will earn 15 to 16% on average annually. So by getting those returns, you'll be able to achieve more money while you're retired. So there you go. My name is Suzanne, aka Trade Babe. If you liked this video this week, please make sure to follow for any future financial topics and advice.